Hi guys, a very good evening to all of y'all. Today we'll be looking at another old standard which is IAS 37, provision, contingent liabilities and contingent asset. For most of y'all, this might be a recap session. Why? Y'all have learned this in your foundation levels or any other academic qualification that y'all have so far. Okay, so I'll try to keep this debrief as short as possible. Okay, okay. So what I would try to do is try to soon finish off with provisions, move into contingent liabilities, and after it, conclude the session with contingent assets. We'll be having some questions here and there to bring back our memory in terms of IS 37. Okay. Our first question is what or what do I call as provision? Okay. In simple, provision is a liability. Okay. It has the characteristic of a liability. But how does it differ from liabilities? It is uncertain timing or uncertain amount. Now, what do I mean by this is, see, for an example, take bank loan, which is a liability. You know how much you're supposed to pay each and every year. You know for how many years you're supposed to pay. So there is certain timing, there is certain amount. But in terms of provision, yes, even though it's a liability, you cannot exactly tell how much you're supposed to pay in terms of dollars or in terms of value, or you cannot tell for how many years you're planning on paying. Sometimes it can be for less than 2 years, sometimes it can be 3 or 4 or 5 or 10 years. It depends. So that is the difference between a provision and your general liability. Okay. For an example, let us take two common examples that we are learning in our worldly business. One is a warranty, one is a court case. Now see, we might be selling, say I'm producing this plastic bottle and I'm selling it to my customers. Okay. You know, any business, when they are selling, they will give you all, or they will give the customers with warranties. Okay. Now, can you exactly tell me when will the customer come? Can you exactly tell me when the customer comes? Sometimes he might be coming within another 2 years, sometimes he might be coming immediately. It depends on the level of damage. Okay. And number two, we do not know how much amount we need to pay. See, sometimes this bottle, there might be a minor damage or there might be a major damage. We don't know. It depends from customer to customer. Okay. So that is why I'm telling you all provision, yes, it's a liability, but there is no uncertain amount or there is no uncertain timing. We do not know when the customer will come and give us, or we do not know how much of cost we need to incur in terms of your liability provision. Okay. Second example I would say is your court case. Say an employee was working for a company, right? An employee was working for a company. There was an unfair dismissal. We all immediately fired him for any unfair dismissal. Okay. So he went and lodged a complaint in the courts. Okay. Now, you all need to recognize a provision. Okay. You all need to recognize a provision, but you all don't know what the verdict would be. You all don't know what the verdict would be. You all don't know whether you all are required to pay or not. Okay, it all depends on the judgment. And you all know judgment is not given within a day or within a month. It drags and drags and drags, say sometimes more than 3 to 5 years. Okay. So court case provision is also, yes, it's a liability, yes, but we cannot exactly determine for how long we need to recognize that court case provision, or we do not know how much is the final payment that I need to release in terms of that particular case. Okay. So that is what we mean by provision. Provision is a liability, but what's the difference? We cannot exactly tell how much is the amount that I need to pay or how in between how long will I be able to pay. Okay. Now, liability, of course, you all know. Liability is a present obligation. Liability is a present obligation. Okay. And examples of liabilities, I of course don't need to tell you all. It can be anything. It can be your bank loan, which is your non-current liability, or it can be your trade payables, which is your current liability. Okay. And these are some petty liabilities as well. And another component of your liability would is, see, liability is always from your past transaction of events. It's always from your past transactions or events. What do I mean is, through past transaction or events is, uh, let me take my monthly electricity bill. See, I am planning on paying, or I am required to pay for this current month my electricity, right? Or water, any of this bill. I am in a present obligation in this particular month. But this present obligation is because of the services that I incurred from my water or from my electricity from my previous month. Okay, you all take your electricity, you all take your water, you all take your telephone bills. All of these are your present obligations. You all need to pay it in this particular month, present. But you all incur the services for your previous last month. For an example, say we are standing in 31st March is the date I am supposed to pay my electricity, water, and telephone charges. But what happened is I have incurred those expenses on 28th February, right? So in simple terms, they are from past transactions. They are from past transactions. And number three is by incurring this present obligation, you all are required to pay. Okay, you all are required to pay. So there will be an outflow of economic benefits. Obviously, right? If you all are required to pay, you all need to release off from your business cash. So cash is an outflow of your economic benefit. As simple as it is. Okay, are we done? Yeah. Okay. Now, coming into a major question. Coming into a major question. But before that, now you all might be asking, now see, this is not required at all. This particular part is not required at all, but I want to give you all a detailed understanding of why are we learning standards. See, normally IAS does not come up with any standard just for its own sake. There is a reason. Okay. So in terms of IAS 37 in specific, why did IASB bring it? It is simple. Okay. What are directors, okay, during the 1950s, 1960s, what they used to do is they used to play with this provision. They used to play with this provision. Why they used to play is, as we know, even though it's a liability, we do not know, we do not know how much we need to pay or the time that we need to pay. It is full of uncertainty, right? As per the definition of provision itself, it is full of uncertainty. So therefore, what our directors earlier used to do is they used to play with this. I'll tell you how they used to play. Or you all can logically think, how me as a director can I play with my liability? Okay. What they used to do is, you all know the double entry of provision. Okay. Let me tell that as well. The double entry of provision or any liability that you all have, it is debit expenses. Right? It can be any expenses into your profit or loss. And you credit your liability under the narration of provisions, right? Now, what used to happen is in a 1950s, 1960s period, directors, what they used to do is they used to purposely increase the provision. Okay. Say you take a financial year which has 12 months. During the first 6 months, what they used to do is they used to purposely increase the provision. Okay. If they increase the provision, what they're trying to do is They are trying to overstate the expense. If your provision increases, your expense also will gradually increase. So because of that, they used to overstate it. And they used to bring down the profits lower. You all can ask me, what is the impact? Obviously, I know when you bring your profits lower, you all need to pay lesser taxes. So that is one of the performance indicator for them to get a bonus. Okay, you all know directors get bonus based on their performance. So for the first 6 months, what they used to do, they used to increase the expenses, and because of that, their profits fell, and because of that, they need to pay less amount of income taxes. Okay, and after what they used to do is they purposely again they used to reduce the provision during the last 3 4 months. Say during October to December, during that particular quarter, they will purposely go and reduce your provision. You all need to understand again, when I'm reducing my provision, obviously my expenses also would reduce. If my expenses fall, my profit would increase from the other side. So then, as shareholders, we feel that yes, the company is performing very well. Why? Because for 6 months they were at a loss. They were they were they were only producing lesser amount of profits. But during the latter stage, they are producing a large amount of profits. So then our shareholders would blindly believe and they would tell, okay, the company is performing very well. Their performance is very well. The performance is quite well. So let us give or let us declare the directors for a bonus. Okay, that is what happened. But in real life, the IASB found out that it was not real profits, it was artificial profits. Why? Because the directors were purposely, intentionally playing with your provisions. They purposely increased it during the first 6 months, and later on, during the last 3 months of your financial year, they reduced it. Okay. So that is why IASB brought up this particular standard. It was misleading the shareholders and it was inappropriate or inaccurate reporting. Okay, because according to prudence concept, you can never overstate an asset or you can never overstate a liability. Same applies to you can never understate an asset, you can never understate a liability. Okay, okay. So this is also done. Okay. Now, coming to the next story. We know that IASB introduced this particular standard IAS 37. Now, how do I recognize a provision is my next question. Or when do I recognize a provision? Okay. If you need to recognize a provision, what needs to happen is you all need to meet all these three conditions. There are three conditions and you all need to meet all of them. Okay. Okay, let me tell you. If at least one of these conditions are not met, then you all cannot consider this as a provision. Okay, in simple terms, if it's not a provision, you all cannot go and show it under your liability part in your balance sheet. Okay. First of all, a provision is a present obligation from a past transaction or event. That is what we know. Okay. Provision can arise in two different ways. One is through legal obligation, one is through constructive obligation. Okay. What do I mean through legal is, see, provision for income taxes. It is a legal obligation. Legal obligation means it has been determined by your law. You cannot evade it or you cannot avoid it. You have to pay your income taxes. Okay, that is one of the legal obligation. Okay, another one would be, say, if you are signing and giving. Now, these large companies which have oil rigs means they, how they extract oil in your mid sea. Okay, what they would do is they would sign a contract, say that after they operate the business and extract all the oil, and when they are leaving, they'll make sure that they do a mandatory cleanup. Okay, why you all know, right? It will damage the ocean bed, it will cause water pollution, all of those. After this business runs its business activity, they will make sure that they do the cleanup. Okay, that is also another way of legal obligation. Why? Because they are writing it and giving in written statements. Okay, in terms of your constructive obligation, in constructive obligation, what I mean is we are not signing anything. Okay, I'm not signing anything on the paper, neither I am not required by law to do it. But these arise because of your business's past practice or policies. Now, for an example, see, there is something called the refunds. You all would have known when you all are buying, purchasing anything from any outlets. You all know there is something called warranties. Does the business say that exactly if there is any damage that they will make sure they give warranty? No, they do not sign and give, right? They do not exactly sign and give. Know that we are 100% obliged to give you all warranty. No, it's not required by law. Neither is nowhere written and signed, right? These are because of the company gives you all warranties, the company gives you all refund policies are based on their past business practices. Okay, because they gave last year, they created a constructive obligation for the customers. Because of that, this year also, there is a tendency that the customers would come and ask for the same warranty, for the same cash refund policy. Okay, so that is condition number one. You all need to have a present obligation, which could either be a legal obligation or a constructive obligation. Okay. Number two is, you all know, right? There is a present obligation. To settle that obligation, we will have probable outflow of economic resources. Okay. What do I mean by this is, what do I mean by probable outflow of economic resources is, yes, I need to settle my liability. I need to settle my liability at present. Because of that, I will have to pay cash. Okay. But that cash payment needs to be probable. What do I mean by probable is that event or that transaction of cash payment occurring is more than 50%, right? The chances of me paying that particular payment is more than 50%. That is what I mean by probable. Okay, so always look at, if they give you an MCQ, if they give an MCQ, always look at for this word of probable. Right? It should not just be a simple outflow, it has to be a probable outflow. What do I again mean by probable? That transaction will happen and that chance of happening is more than 50%. Right? The occurrence level is beyond 50%. That is what I mean by probable. Finally, you all know you all need to record this in your balance sheet, right? But at what amount you all will record? You all need to have a reliable estimate, right? You all need to have a reliable estimate of your present obligation. What do I mean by this? At the year end, I need to report a liability in terms of provision. How much do I go and throw? Is it 100? Is it 1000? Is it 100,000? That measurement of value needs to be reliably estimated. Okay. Okay. We need to meet the recognition criteria, right? Which is present obligation, probable economic outflow of cash, and number three, a reliable estimate. If all these three conditions are met, then you all need to do the accounting for provision. Okay, that is what we are going to look at now. Okay. Now you all know provision is full of uncertainty. We do not know exactly how much we need to pay, or we do not know within how long are we supposed to pay. Right? Both of those two are uncertain. So what we need to do? If we do not know how much is the value, or if we do not know within how long I'm supposed to pay, you all need to estimate it. You all need to estimate. Now, in terms of estimate, obviously it's full of judgment. Why? Because we are going to estimate for the future. We are going to estimate it for the future. So, what we tend to do is we would either overestimate or we would either underestimate. Okay, but there are certain people of estimators, I would say, their estimation is only just full of worst case scenario. What if in the future I only have worst case, or if I only have bad conditions? That is how they estimate. Now they are wrong. Why? Because in future we need to incorporate both favorable condition as well as unfavorable condition too. Right? Who knows, in the future you all might be having some favorable or positive impact in terms of your estimate that you all are preparing. So therefore, you all are required to take the best estimate, which includes both the worst case scenario as well as the positive case scenario as well. Or in another word, I would say both your positive impact and your negative impact needs to be incorporated when you all are doing your estimate for provision. Okay. Now you can ask who will be making the estimates. There are two people. One is your internal management. Number two is your independent valuers. Okay. How will your internal management make estimate is, for example, let us take the warranty. Okay. They are supposed to make an estimate for your current year. How they will make it is in simple. They will go and look at the history of people coming and claiming warranty for the past 3 to 5 years. Say there was about customers between 30 to 50 came and returned and got claim warranty. Then for your current year, they will also estimate that, okay, maximum there would be a 50% customer that is coming and returning, and minimum there would be a 30% of customer who would be coming and returning and claiming warranty, right? So that is how they decide. Management, they would decide based on the past history. Now, in terms of court case, you all know business does not always go into court case, right? For example, I had a court case last year. I'm going to have a court case this year. I'm going to have a court case next year. That will not happen. So in that, you all do not take management's judgment. You all need to take independent valuer's judgment. Okay, there are some legal expertise people, right, who have specialized knowledge only in terms of legal. So they look at that particular case and they'll give us an estimate. Okay, this is going to succeed or this is going to fail. Or they'll tell us you will be having a rough amount of or an estimate amount of 500,000, or you'll be having an estimate amount of 300,000. You will be needing to pay within a year. You will be needing to pay within 5 years. This is how independent valuers come into play. Okay. Okay. Now in terms of your accounting, I told her, right, if it's a one-off transaction, right, what do I mean by one-off? Court cases. Court cases, we do not every year, as I told, we do not every year go to the court and have cases, right? Rarely, once or twice, we'll be facing it. If it's a one-off event, y'all are supposed to take the most likely outcome, right? Or in simple terms, reliable outcome. Now let us look at this particular question. Okay, to identify how do you do a reliable estimate when it's a one-off transaction? Okay, the question is what amount of provision should be recognized? Okay, an entity has to rectify a serious fault of an item of a plant that was constructed for a customer. The individual most likely outcome, okay, they have directly given us that the most likely outcome to repair this will succeed at its first attempt at a cost of 400,000. Right? So they are telling us how much is the most likely outcome if they are planning on repairing this particular property, plant, and equipment, and that is 400,000. Okay. So therefore, what you all need to do is you all need to go and create a provision. Debit expense, for example, I could say it as fault expenses, and you can credit your provision by 400,000. Okay. Now reading on, but there is a chance. Now you all need to understand chance means it is possible, right? It is not probable. Chance means 50-50. It could either succeed, it could either fail. That a further attempt will be necessary, increasing the total cost to 500,000, right? So what I want to tell you all here is since the most likeliest outcome is already predicted, it is 400,000, you all need to go and record it at that. You all will not record it at 500,000. Why? Because this is possible, right? 50-50 is not allowed. Or you all will not go and increase your provision by 100,000 also. Why? Again, I'm telling you all because it is possible. Can you look at this word called chance? Right? This is the reason I am keeping my provision at 400,000. Why? Because that is the most likeliest outcome. Okay. Now, coming to next best part, if you all have continuous events, like for example, let us take a warranty provision. See, warranty provision, there might be different customers coming at different periods to claim warranty, right? So this is a frequently happening event, not like your court case, which is one-off event. Okay. So then how will you all determine? I told you all, we will be determining the level of provision based on your number of repairs. You all will have a history of a track record. For this customer, this was the amount for this particular damage. For another customer, he had a separate damage and that was a particular cost. All of this will be based on your history. Okay. So as I told you all, if you all have frequently occurring events, then you all need to use a method known as expected value. Right? Don't go and use this method, which is one-off event. If it's a one-off event, you all need to use most likely outcome. If it's a frequently or recurringly happening event, then you all need to use expected value. Okay, so let us look into this. Now, see, expected is quite easy. You all would have learned it in your management accounting, I believe, but let us again redo it. Again, the same question. What amount of provision should be made? An entity says good with a warranty covering customers for defects that are discovered within the first 2 months after purchase. Okay, fine. Past experience suggests that 88% of the goods sold will have no defects. That means this chunk, there is no defects, right? Okay. 7% will have minor defects. That is this chunk. Okay, and 5% will have major defects. That is this part. Okay. Now we are going to find out the expected value. If minor defects were were detected in all products sold, the cost of repair would be 24,000. Okay, if it's for minor. If it's a major, the cost would be 200,000. Okay. Now, how do we calculate expected value? How do we calculate expected value? Based on your probability. Okay, based on your probability. We know if it's minor, there's a probability of it occurring 7%, and if it's major, there's a probability of it occurring is 5%. Okay, so that I'll go and put it here. That you all need to go and put it here. And they told you all, again by referring to the question itself, they told you all 24,000 will be incurred if there is a minor occurrence. Okay, so therefore your expected value would be is 1,680. How did I arrive at that? 24,000 is the cost if it's a minor level damage, but there's a 7% chance only of it occurring. Okay, same thing again for major. There will be a 200,000 cost if it's a major damage, but again, there is only 5% probability of it occurring. So therefore, you'll be arriving at a expected value of 10,000, right? So in total, your expected value would be 11,680. So you all need to recognize an expense of 11,680 and a provision of 11,680. Okay. 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 And I've given you all a note. I've given you all a note. So see, normally we cannot expect our provision in terms of warranty to be stable, right? Last year, yes, it was 30. This year it is again 30, but next year, if our product is worse, then a larger amount of customers would come and return. So what I mean is each year, each reporting date, you all need to check your provision for warranty if it's correct or not. Say next year, if we see that our product is quite crappy, or if it's a low quality product, then obviously we will be having an increase in warranty claims. If we have produced this year a proper product, then obviously next year there would be a decrease in warranty claims. Why? Because we have produced a quality product, so that next year no one will come and claim warranty. Okay, so this is in summary. How do we account? If it's a one-off event like court case, you all need to use the most likeliest outcome. If it's an event that is going to occur frequently, then you all need to use something called as expected value. Okay. Now let us look into your increase in provision or decrease in provision, or in other terms, over provision and under provision. Now, why am I including this here is because this can be tested under your section C under your company adjustments. Okay. Yeah. Okay. So now see for an example, you all are standing in 31st December 2001, right? Which is your last day of reporting. We all know tax payments are there, right? We will be paying it at each quarter. Okay. Say for an example, October, November, December. This quarter's payment will be paid in your next financial year, which is 31st January 2002. Okay, so obviously we are concluding our financial year for 31st December 2001, right? But the payment is being made in your next year on January. So therefore, we are required to create a provision. Okay. So what we went and did on 31st December 2001, we went and created a provision of 100,000, right? That is what we expected initially. But as days were passing on, we found out that we have underestimated, or in other terms, we have under provisioned, right? Why? Because actually, what happened was we had to create a provision of 130,000, but since we had a wrong judgment or a wrong estimation, we only provisioned for 100,000. So can you see here? There is an under provision or there is a decrease in provision of 30,000, right? So what you all need to do? What you all need to do? You all need to go and increase the provision. Why? Because last year you all only provisioned for 100,000, expecting that 100,000 is the only amount that you all need to pay for tax. But actually, in real life scenario, you all found out you all need to pay 130,000. So you all have done an under provision. So what you all will be doing? You all need to go and increase the provision. How will you all increase? Simply debit your relevant expense and you credit your provision. Okay. Same thing happens. Same thing happens if it's an over provision. For an example, say you all expected next day your tax payment to be 80,000, right? But in actually, what happened was your tax payment only was 60,000 for your next year. So can you see here? You all have overestimated. You all have over provisioned your provision for income tax by 20,000. Therefore, what you all need to do? You all will be going in decreasing. You all need to go and decrease the overestimate or over provision in terms of your tax expense. By how much? 20,000. In terms of its double entry, your provision is going to decrease, right? Provision is a liability. So when liability decreases, it's a debit. And you all need to credit your relevant expenditure. Okay, this is it in terms of your provision part.